All right, guys. So we have already seen that for last couple of days, AI trade is taking a breather. And just about now, you might be wondering, did I make a mistake? Should I have booked the profit or should I book the profit now? Is market rotating? Are we going into software? Are we going into safety stocks? We're seeing what's happening with bond yields, right? 10-year is almost 4.6 now, 30-year already crossed 5.0. Well, I think it's close to 5.2 if I'm not wrong right now. So these are all the scary signs. And obviously, whenever the bond yield rises, then the stock prices will show weakness. So bond prices are kind of like gravity; they bring the PE down for many stocks. So this is very natural to happen. And the question really remains: is can these bond yields continue to go up? Can 10-year go to 5.0 or perhaps even more than that? So these are all legit questions. I'm going to try to answer them. How do I think about the markets in such environment and help you think a little bit broadly and hopefully help you avoid make some of the mistakes that a lot of people make in the market. So, for example, some of the questions that you might be thinking about is what is really happening underneath the all the pricing volatility that we are seeing. So that is what my focus is. That is what kind of keeps me grounded and help me think about where do I want to go from here. So once again, those of you guys who don't know me, my name is Deepak. I'm a tax code advisor. So if you need some tax advice, you're looking for someone to help you out with your taxes, then I'm your guy. Go to taxcodeadvisors.com and you can reach out to me from there. Now, there are two events that are coming up now. Number one, at the end of May, I think on May 30th, Saturday at 10 a.m. Pacific Standard Time, me and Sanjeev Gupta, CPA, going to be doing a webinar on mid-year tax planning. So if you are need some help with your taxes this year, then I will strongly urge you to join that webinar. So once again, that is on end of this May. And then the first week of June, I will be coming to the Bay Area and I'll set up a meetup. I'll put a link for both of these events in part of this video so you can sign up. So if you want to come see me in person and talk about some of the things that I'm going to discuss today, then you're welcome to do that. Okay. All of you guys who came to my Austin event last week, thank you so much. You guys made my day. We had awesome time. And hopefully you guys got a ton of value as always. If you don't know me, I'm not an investment advisor. I'm not here to tell you what to buy, what to sell. So please certainly don't take any action based on what I say. Use this video as an educational tool only. So let's talk about what is happening in the market and then we'll dig a little bit deeper in it. You see, right now, we're watching some volatility in the market. And this may think, is this a start of big volatility? Because what happens is whenever the volatility starts, those messages start to get amplified. More and more people start talking about it. A lot of people who are sitting on the sideline or people who are not participating in the trade, they say, hey, look, we knew this was bad. It's going to come back down. And so forth. And then you're going to get technical people. They'll say, oh, it broke this support. Now it's going to break this support and then this support. So those kind of messages get amplified in this environment. So the question we have to ask is this the beginning of a new software cycle? Or is this an end of semiconductor cycle? Or is there something else going on in market that we should be paying attention to? And for that, we need to look at hyperscalers. Why are they spending so much money in 2026? Remember, they did not do that in 2025. They're spending way more money, and we are still in the beginning of the year. So there's much more dollars coming to the market over the next 6 months. Then AI trade. So far, we can see that AI trade is the center of gravity. Everything else moves around it. So what's happening with that? Is anything changed with that? What about semiconductors? Are they ready to take a breather? They're ready to cool down. All of a sudden, people don't need as many GPUs, CPUs, memory, are like the whole world is done with it. What about software? Is it time that software can start to bounce? So we'll talk a little bit about that. And what about AI agents? So, for example, Google Conference, there was a big talk about AI agents. What's happening with them? Robotics, I'm very, very big bull on robotics. I think that is one thing that is going to make a lot of difference over the next few years. So we're going to talk about that. And then energy itself. This year has been an energy year, right? Whether it's at gas pump or we look at the bottlenecks in the AI trade, everybody's talking about energy. So I have so much to share with you guys today. So do me a favor, at least give this video a like, subscribe to the channel, and don't leave without leaving a comment. Please tell me what your thoughts are. What do you think? So we can have a proper conversation around this topic. So let's get started. One of the most important shifts happening right now is that market has moved from AI hype to AI monetization. That is a big deal. If you guys remember, even in our WhatsApp group last year, every time we were talking about Nvidia, we were talking about AMD or any other company, people kept saying, this is a hype, this is a hype, this is a hype. That conversation is dead. Nobody's talking about that. Now people are talking about monetization. And this distinction is important. In 2021, people were not sure what the total addressable market for AI really is. Other reason people say, hey, stocks are simply going up because money is cheap and PEs were expanded. But what about today? I mean, money is expensive today. Interest rates are almost close to 10%. If you want to go start a small business, go to SBA and ask for some loan, it's 10%. So the companies right now are acting completely different than the way they were acting a couple of years ago. Now companies have real revenue growth, real contracts, real deployments, real earnings acceleration. So everything has changed around that. Cash flow is a big deal. I mean, take a look at some of these companies. They are sitting on enormous cash flows. Nvidia, Broadcom, TSMC, Micron, all the hyperscalers, they are printing money. These companies are not trading higher today because of some exciting news or because of some hype. They are trading higher because the earnings are exploding alongside demand. That is why comparing today's market with anything that you might have seen in past doesn't make any sense. This cycle has infrastructure economics underneath it. So you build the infrastructure first and then the real boom comes in. So a lot of people who think that we are done with this cycle or they think that we are close to the top or anything like that, maybe they haven't really studied infrastructures. What happens to property prices after a major highway is built? What happens when a new factory is built? Think about that. The real benefit of what is happening in the United States, you haven't even seen it. And I'm going to try to paint a big picture today to help you understand it. So stick around with me. The real story of AI used to be Nvidia. That is not the case anymore. The real story today is the hyperscalers arm race. Companies like Microsoft, Amazon, Google, Meta, these companies are deploying hundreds of billions of dollars into AI infrastructure. And guess what? They're all doing it at the same time. And when you do that, it is natural for you to see inflation. I mean, if you go in a town and they start building all bunch of residential and commercial all at the same time, obviously the trucking cost going to go higher, the labor cost going to go higher. So the talk that we are hearing about inflation right now, I don't think that is going away anytime soon. Because when you build such an infrastructure, inflation simply comes as side effect. Now, for the first time in the memory industry history, customers are not resisting higher prices. Instead, they are signing multi year agreements, securing long duration capacity, locking in memory supply, competing for compute availability. That changes the entire structure of the cycle. Historically speaking, memory storage was cyclical because customers reduce purchases when prices increase. I mean, that's what we do as consumers. Today, the story is completely different. Demand is so urgent that hyperscalers are willingly absorbing elevated cost because they already know future compute demand exceeds future supply. So people will rather pay for that today than paying it for future. Now, let me rephrase it another way. Let's just say you need to build a house. Do you think you should have built the house 5 years ago or today? If you can do any math, you will probably arrive at a conclusion that it was probably cheaper to build the house 5 years ago because today interest rates are higher. There's a bigger inflation, and everything is just so much more expensive. So, same thing we are seeing right now with this AI trade. Everybody wants to get there as fast as they can. Now, most investors still think that AI is just about buying GPUs. Maybe some of you think about CPUs. But every solved bottleneck is revealing another bottleneck. Like you solve one problem and then you come up at another problem. The AI built out is cascading through the entire economy. First, it started with GPU shortages. That's when we saw Nvidia moving up. Then we realized, well, if you're going to have a lot of GPUs, you're going to need a lot of memory. And then memory start going up. Then came time from AMD. We learned that all of a sudden we need so many more CPUs than we thought we did. And the AMD shoot up. Then we had networking components, optical bottlenecks, then power availability, cooling systems. I mean, take a look at some of the cooling companies. I mean, they are trading like an IT company now, like they have built some new product. And now, even transformers and electrical grid infrastructure companies are trading at premium. Every layer of the stack is becoming constrained simultaneously because the world is trying to build AI infrastructure at really large scale. Now I use the word world, but reality it's mostly happening in United States and China. I think it's going to cascade into the entire world very very soon. And this cycle continues to get more and more broadened. AI isn't just a semiconductor story anymore. It is becoming an industrial story, infrastructure story, and eventually an energy story. So you have to keep your eye on the ball and stay focused on that. I'll give you a simple example. So, for example, if you would have joined the coaching program in April, right? In April, when market was somewhat starting to stabilize. Not, it wasn't really too bad, it wasn't too good, just stabilize. Many of the stock, I would say most of the stocks, has gone up almost 100% since then. So can you imagine just in April, that was like less than a month ago, the market moved so much. So why did it move so much? What just changed? When the earnings report started to come out, the players started to realize that this AI infrastructure story is real. And once again, today you're seeing more and more people talking about that this story is going to get killed because of higher interest rates. I don't think so. Now, does that mean we're not going to see correction? Does that mean we're not going to see red days? Absolutely not. Of course we will. I mean, that is a question of liquidity. When people are on margin, when people have higher debt, when the interest rates goes up, all of those people are going to take their money out. So that is certainly going to hurt. Then we have international market. For example, right now in memory player, we have a Korean market, which is highly leveraged right now. So obviously they can create some weakness as well. So all of those problems are still there. But point I'm trying to make is very simple that there is just so much demand for this AI trade right now that getting out of the market is just as risky as staying in the market right now. So what do we do? Well, then I need to think about my downside and upside risk. Without that, I cannot move. So, for example, what happens if interest rates continue to go up? Well, market going to slow down a little bit. There's going to be some weakness. But once the earnings report come out, when the next quarter come out and we see those earnings going up, guess what? Money is going to move back into the trade. We saw that earlier. It's not like the first time we have seen inflation going up. We have seen much higher inflation. And what happened? Market continued to go up. In matter of fact, that gives these people more reason to increase the prices. I mean, think about Micron, for example. Micron can say, hey, look, inflation is hitting 10%, so we're going to increase the price by 20% or 30%, whatever it is. So typically, inflation is good for these companies because they get to raise the prices. It's bad for consumer. It's bad for people like you and me who's paying for that inflation, but that's just the reality. Now, the market originally thought AI was mostly about training models. That was phase one. And the phase one really belonged to Nvidia. Now, I personally missed out on that rally. At that time, I was dealing with some medical issues in family. And honestly, I decided to stay out of the market because I did not have the mental bandwidth to even think about it. So I completely missed out on that rally. But now we're in phase two, and phase two is all about inference. And I'm not missing out on that rally. For example, I got into AMD when AMD was around $100. I got into Micron when it was about $100. Shoot, right now I lose more money in Micron in a single day sometimes than I had originally invested in Micron. So kind of crazy how market works. But anyhow, Point I'm trying to say is I'm not missing out on this rally, and let me help you understand what I mean. Inference changes the economics completely. Chatbots were just the appetizer. AI agents are the real transition because chatbot answer questions. Agents execute workflows. The truth is, a lot of people don't even know what I'm talking about right now. They have never set up a workflow. They have never let a chatbot actually execute a task. This hasn't even begun. Only people in enterprises or people who are highly educated in AI, they're the only one who are using this technology right now. See, agents execute your workflows. Anything that is repetitive, you can make that work. That means AI is now moving from consumer novelty into an enterprise dependency. Agents, you already know, can write codes, manage workflows, analyze data, automate research, execute repetitive tasks, coordinate operations, and who knows what else they're going to do in the near future. But I have some idea and I'll share that with you. This creates persistent compute demand, not one time demand, persistent. Like once you get hooked onto it, that is just how it is. It's not like Zoom that you only needed during COVID time, right? Now, well, obviously, we still use Zoom, but just it's not going to go up as much as what it did in COVID time. But this AI inference is completely different. And this may be the most underappreciated part of current cycle of phase two. But then I'm more excited about phase three, which hasn't even touched the market yet. So, one of the strongest ideas emerging in enterprise AI is that companies are increasingly reallocating budget away from labor and towards compute. Now, you might say, Deepak, isn't that bad? That means job losses, people. I mean, why would you be so excited about that? Yeah, whenever something like that happen, it creates disruption. I'll give you that. I'm 100% there. Do we need to work on finding other ways to find jobs for people who might lose because of this? Absolutely. But that is not the topic of today's discussion. That is a problem that we do need to think about, but let's just put that aside. I want to talk about it from a financial point of view only. Again, this measure does sound extreme, but let's take a look at what is actually happening. Many companies are now reducing administrative headcounts. We've been seeing that in Google, Meta, many other companies. They're flattening the middle management. They're automating workflows. They're consolidating software spending. At the same time, they're increasing spending where? In GPU budgets, inference budgets, cloud spending, AI infrastructure investments. Why are they doing this? Look, they're doing this because they see value. They see that this process is going to generate more profits than investing in people. This is a shift in capital. AI is now competing directly against labor costs. This is a big shift. Continue to pay attention to it. Now, will it result in job losses? Absolutely. I'm not arguing that at all. Now, one of the biggest debate right now is why are semiconductors dominating while software stocks remain inconsistent? Cybersecurity is up, rest of the software industry is not doing that good. The answer to that question is very simple. Infrastructure side has already proved monetization. That was not the case a couple of years ago, but today you ask any company, hey, you're spending this money, do you think they're going to be ROI? And they will say, absolutely, the money will come back within a couple of years. Software, on the other hand, is getting attacked from two different sides. See, many enterprise software companies are facing this difficult transition. On one side, AI is increasing their cost. They have to pay more for compute, more for memory, more for inference. And on the other hand, it makes it easy for their customers to build their custom software, and it is making it easy for their competitors to launch a competing product. So the question now, from a customer point of view, is who is going to win? And that is why softwares are struggling. That is why market continue to reward infrastructure suppliers, computer providers, networking companies, memory manufacturers, rather than broadly re-rating software names equally. Market is saying, well, show me who can survive, who is going to last in this tsunami right now. And then another thing I want you to also think about is the involvement of management. AI, technology, compute, memory. Who should think about this? Typically, that would be a CTO, right? Somebody in charge in technology. Not anymore. Now, board members, CEOs are directly getting involved in this. This is a major shift. Boards are asking, what are you doing with AI? Because executives understand something critical. If competitors successfully deploy AI first, they may never catch up. That fear itself is driving spending. This creates reflexive cycle. Competitors adopt AI, productivity increases, pressure rises, adoption accelerates even further. This is why AI spending may remain elevated way longer than many people expect. In matter of fact, a lot of my clients haven't even started with this yet because they think AI is still expensive. On the other hand, corporate fear can become its own demand engine because if, profit, like imagine if you're running a big company and at the end of the year, your profits are not there. What do you think your shareholders are going to ask you? Well, what did you do with AI? Did you implement AI in your company? Are you reducing cost using AI? What are you really doing? And if your answer is, "Oh, sorry, I didn't do it," well, guess what? That's going to make a lot of people upset. Now, I have to talk about the bonds, right? Because that is such an important part of the whole story. And that is perhaps the root cause of market tension right now. When a 10-year treasury moves above 4.5%, all of a sudden math changes. Discounted cash flow models compresses, long duration growth assets get punished. For example, gold, biotech stocks, real estate stocks. I mean, these companies not going to produce results in 6 months, a year. It's going to happen over the next 3, 4, 5 years. So when bond yield rises, markets start to discount these companies. Profitable AI infrastructure companies are holding much better. I mean, take a look at Micron. I was checking today. It's still up almost 3, 4%. Why? Because they have current cash flow. They have current demand. They have earning expansion. This is why speculative names are going to struggle over the next few months, while companies that have solid cash flow are going to thrive. So you want to pay attention to that. Another question that people keep asking me is this a bubble? Are we on top? Is this going to bust? Um, because a lot of people are already in this trade. Well, that is not really true. Not true at all. Many institutional managers remain underweight. Many investors still distrust the rally. Large amount of capital is still on the sideline because true speculative tops happen when nobody is skeptical anymore. Everybody believe in the rally. But skepticism remains everywhere. People are worried about valuations. People, I mean, even on Discord community, people are asking me that question all the time. People are super worried about rate. I mean, tell me, are you not worried about rate? If you really thought that rate's going to come down to, let's say, 3% over the next 6 months, wouldn't you put in more money in the market? I think you would agree, right? Let me ask you another question. Are you worried about inflation? You probably say, yeah. Um, then there is this uncertainty around what Trump administration might do. Maybe a different regulation. Maybe he decides to go attack Iran. Who knows what else they might do? Anyhow, my main point is people are not so bullish as you think they are. In matter of fact, many people did not even participate in the rally. Like I gave you an example. If you would have joined the program in April, most likely you'll be up almost 80, 90%. I think I'm just saying if you have equally distributed to every single stock we were looking at back in April. But not everybody did that. I mean, how many people are really up 100%? Not that many. Why? Because people are not participating in the market. They're just sitting on the sideline. Um, and that's the main point here, by the way. Not that, last month was a great month. These ups and downs happens all the time. My main point is that don't think that everybody is in. There's plenty of room in this market. Let's talk about robotics. I'm so excited about robotics, and maybe this is one of the topics that we can talk about at the next meetup. But if an A, so we already know that AI is displacing jobs. You would agree with that, right? Okay, we're good. Second thing is AI agents are digitizing labor at this point. I think we all can agree on that. Then robotics can physicalize labor as well. The robotics may ultimately become the largest total addressable market in human history. That is the main reason why Tesla stock continues to go up no matter what. I mean, they haven't really grown a whole lot. Earnings are not that great. Profitability is not there. Still, the stock keeps going up. I mean, take a look at their history, and you'll be surprised. Why? Because people invested in Tesla are really counting on this aspect that this can be a big boom for them. Now, why now? Why can this really happen? So let's talk about it. Well, we know that AI can now reason, AI can plan, it can interpret environment, and it can interact physically with the real world. You saw what Google launched just today. Take a look how fast it is moving. Every industry that you know of is going to change by AI over the next few years. Let me give you some examples. You already know what's happening with cars, you already know what's happening with trucks, but now let's go a little bit bigger. Warehousing, manufacturing, healthcare, construction, defense, logistics. Any industry that you can think of is going to change, including retail. This is the transition from digital intelligence into physical intelligence. Nobody is even talking about that just yet. It is going to be so big that you can't even imagine how fast S&P 500 and Nasdaq is going to move. Physical AI massively expands compute demand beyond the data center. Two things. Number one, right now data centers are not nearby, they're kind of far away. But for physical AI, for inference, you're going to need data center, you're going to need compute way closer to where the end user is. That's why I'm so bullish on Micron and some of the other AI trade right now. So let me give you some examples so that way you can think in that direction. Think about sensors. Physical AI going to need a lot of sensor, right? All kind of sensors, edge processors, cameras, embedded systems, robotics chips, networking, real time inference. I mean, these things are going to blow up just like what you saw with AMD and Nvidia. And we are not even there yet. So, oftentimes people ask me, well, how do I think about companies? Well, I'm only really looking at two things. Number one, I'm looking at innovation, which direction things are innovating. So I kind of gave you a great example of that innovation today. Second thing, I'm looking for insider money flow. Where are the CEOs, CFOs are spending their money? That kind of gives me an idea as well. And right now, during this dip, I'm really more focused on finding companies in semiconductor and energy sector because I'm a little bit weak on that. I have a lot of other stuff, but I want to acquire as much companies in those two sectors right now. Physical AI is there. We already have a couple of stocks in that. So it's not like I'm going to go big in it because I think that is still phase three. I still want to leverage phase two as much as I can. See, sometimes, like for example, I got into a couple of trades last year for physical AI. They did okay. I'm still up significantly on them, but nowhere close to what I thought they're going to do. Why? Well, because we're too early. We're still in phase two. So I'm going to correct that mistake. I'm going to focus on phase two. So once we get to the phase three, then I will think about that after that. Look, market may consolidate for next week, month, 2 months. I don't know. Leadership may rotate. You might see some other stock being hitting all-time high. No problem. Volatility can increase. Bond rates can rise. Trump administration may make things cool down, may not. I don't know. But what I do know is that AI infrastructure continues to attract global capital at extraordinary scale. This is the only one statement you really need to know because this isn't simply a software upgrade. It is a rebuild of the digital economy physical foundation and eventually the physical economy itself. The market still thinks AI is just a speculative bet. Maybe they are thinking more of it like chat gpt, but reality is it's becoming clear that AI is an infrastructure story, industrial story, and it's going to basically impact all part of our life. The winners may not only be the companies creating intelligence, it will be all kind of companies, so you can participate in AI trade from many different ways. So I hope I was able to convey the main point here. And if you focus on that, I think over the next 4 or 5 years, it can help you build massive amount of wealth. If you want to learn what I am doing, how am I thinking about it, then I encourage you to at least talk to me and learn about the coaching program. Again, I'm not going to try to force you. Like, I wouldn't tell you, oh, join the program now because of this or that. That's just BS. That doesn't make any sense. I want you to join the program if you genuinely want to learn. And if you learn, then you're going to eventually benefit from it anyways, because learning never really goes to waste. There's always some benefit to you, one point or the other. So anyhow, I think that kind of gives you an idea. If you guys want to reach out to me, go to taxcodeadvisors.com, reach out to me from there, and I'll be happy to meet up with you in California. If you are in Bay Area, we're going to set that up in June. And if you're elsewhere in the country, then reach out to me via taxcodeadvisors.com. Thank you guys, and I'll see you very, very soon.